Hi, welcome to the First Trust ROI podcast. I'm Ryan Isakainen, ETF strategist at First Trust. Well, if you're like many investors, you may have begun to question your allocation to international equities and fixed income. After a period of sustained underperformance for many of those markets, investors wonder what the case is for maintaining an allocation. Valuations have become much cheaper relative to the US, and many are also asking questions about whether or not that represents attractive opportunities. Today, my guest is Leonardo Da Costa, portfolio manager at First Trust Global Portfolios. Len and his team manage the First Trust Emerging Market Local Currency Bond ETF, ticker FEMB for First Trust. He also sits on the investment committee, the subcommittee for our First Trust fixed income ETF models. So I'm very much looking forward to the conversation today with Len. I think we'll learn a lot, and I hope you enjoy it. Thank you for joining us on the First Trust ROI podcast. So here we are in London. We're right nearby the historic Tower Bridge. This is more your backyard than my area, so thank you for having us here. And really looking forward to our conversation today. One of the things that I mentioned in the intro was that you are a portfolio manager that focuses on local currency emerging market bonds, as opposed to, I think the majority of emerging market bonds are dollar-denominated, US dollar-denominated. So maybe to start off, explain, what's the difference between emerging market local currency bonds versus dollar-denominated?
Yes, I mean, actually, if I may correct you, the vast majority of bonds out there are actually local currency denominated bonds, and that's maybe
one of these misconceptions, right?
Yeah, it's one of these misconceptions. Your EM local currency bond market is around $16 trillion in size, right? So it's quite a significant asset class. It's seen as being quite niche, particularly to US investors. I think in Europe, because investors tend to be a bit more comfortable with currencies, they focus on it a bit more. There was actually a First Trust employee who I was speaking to them about local currency, and they said, well, Len, to most US investors, there are only two currencies in this world, dollars and cents, right? And so, there is that conception of that. But if you look at the $16 trillion market, about half of that is China. We know, very significant economy. But then there's also, the stalwarts like South Korea, India, Brazil in that universe. And really the distinction between that local currency universe and the dollar-denominated universe is really the dollar-denominated universe, its inception was, it's hard to argue, but or hard to put a point on it. But after the Mexico tequila crisis in '95, you had the initiation of Brady bonds.
There was a tequila. I don't know anything about this tequila crisis, but I want to dig into that a second. What is the tequila crisis?
Well, it's when Mexico had its debt crisis. It was back around '95, '96.
Okay.
And so it was the Treasury Secretary Brady who stepped in and allowed Mexico to issue dollar-denominated bonds, which were backed by or underpinned by U.S. Treasuries.
Okay.
And those became some of the first.
They weren't collateralized with tequila.
No.
Okay.
Well, that would have been something different, right? And so, that was the initiation of the Brady bond market, which then evolved into the Euro bond market. Which is essentially the issuance of dollar-denominated debt overseas. And so many of these emerging markets back at that stage, they had very small, underdeveloped local savings pools. So think of your pension funds, asset managers, and banks. And so they looked to attract or to get capital overseas by issuing dollar-denominated bonds overseas, and then using those proceeds within their budgets. But as those economies developed, they were able to develop their own domestic treasuries. So not issuing like a corporate would in US dollars, but issuing in their own currency. So again, if you look at Mexico, they've got a fully developed Bono curve, what we call it, so issued in Mexican pesos. And so if you look at the distinctions between the two universes, the EM dollar debt universe, there's about 70 countries. A lot of them are frontier. So think of names like Mongolia, Gabon, Angola, and they tend to be the first point of issuance for these countries, right? The average rating is sub-investment grade, whereas for the local currency market, there's about 20 countries. It's just your more advanced EMs, that's your Chinas, Indias, Brazils, Mexicos of this world, average investment grade rated, even though they're emerging markets. So issued in their local currency, a lot more liquid, a lot of these government bonds. And the yield is pretty attractive as well relative to the dollar-denominated bonds. You do, the one distinction is that you do need to focus on the embedded currency risk because you're investing in foreign instruments denominated in foreign currencies, whereas in the dollar debt market, they are dollar instruments, but they essentially trade like spread products. So it's a spread over US Treasury, so you get the US Treasury duration under there, which in the EM dollar debt universe is quite significant because these countries tend to push out the maturities as far as possible. The index duration is somewhere between 8 and 9. So it's quite very long duration assets. So you get a lot of US interest rate sensitivity there. And that's really the major distinction between the two assets.
So you're saying you get more US interest rate sensitivity in the dollar-denominated, not the local currency denominated.
Yes, absolutely.
Right. It certainly sounds like an area where active management, especially in that local currency, where you the local currency issued market, where you want to have the ability to perhaps hedge and not hedge. It seems like an environment or an asset class where you can really have some advantage to having an active manager as opposed to an index fund. And obviously, you manage a fund, so maybe you've got a biased opinion, but that seems to be self-evident that that's the case.
Yeah, so absolutely. You want to be, the important thing is you want to be dynamic. So you can invest in the asset class purely on a hedge basis, but the hedges have a cost to it, right? And they can be quite significant. The hedge cost is typically based on the domestic deposit rate. So you would be, when you're hedging, you'd be paying the domestic deposit rate and earning the US deposit rate. Effectively, that's how it gets priced. And so sometimes you don't want to be hedging because the hedging cost is quite excessive. But other times, it's a lot cheaper to hedge. And then you can also help manage the broader volatility of the portfolio by deciding when to hedge and what areas of the market to hedge.
Okay. I want to also get your opinion. I know you, as a portfolio manager, focus more on fixed income, but of course, you have a pretty wide knowledge about the equity markets in which you invest as well. And so I want to start out broadly. One of the questions that we have gotten in the last several years has been really kind of what's going on with the international equity markets, because I think as people evaluate their asset allocations, they see some attributes of international equities that seem attractive. On the other hand, after a period of underperformance, I think there are people that have maybe begun to second guess those allocations. So I guess as a broad topic to start off, what's your opinion? Is this something where investors should be second guessing their international allocations, or is there some opportunity that maybe is on the horizon?
It's completely understandable, like you say, because international equities have underperformed so significantly, especially since the global financial crisis. Right? The S&P has powered ahead, and we know more recently it's been driven by the Magnificent Seven, right? But more broadly, we've seen U.S. equities perform much better than both Europe and those in many parts of the emerging markets. So I think if you look at from the end of 2008, so since the financial crisis, the S&P has averaged around a 13% annualized return. European equities has been about 8%. But if you measure it in dollar terms, it's been about 6%.
So what you're saying is in their local currencies, they've had an average of 8% return, but because of the dollar, translation back to the US dollar for US investors, that's actually about a 6% return. Have I got that right?
Okay. Yeah. So over the same period, we've seen US equities outperform and the dollar do really well, which is not surprising. Currencies typically are correlated to equity markets. But that's added to the negativity surrounding international investing, and it's not only a problem for U.S. investors. We see it here as well, where if you look at the MSCI World, 68% U.S. stocks, right? The MSCI ACWI, it's around 60%. So there's this big concentration in the US, and for investors here, when you're looking to invest in the US, you're taking that dollar risk as well, so you're cognizant of that currency risk. So yeah, it has been quite a significant force since the global financial crisis. If we do look prior to the global financial crisis, we did see international stocks performing significantly better. So the 10 years before the end of 2008, emerging market equities were annualizing around just under 10% a year. The S&P, because the 10-year period would include the dot-com bubble, and until the global financial crisis, they were slightly down, about 1.5% or so annualized, and European equities in euro terms were actually up over that period. So it hasn't been, there have been times where we have seen international equities outperform for US investors. Just the last 10 years have been very difficult.
It's kind of interesting to me because there are certain other parts of the equity market that have, I think, similarly underperformed. So, for example, one of my theses right now is that the market may broaden out in the next several years, and that may have an opportunity for equal weight biases or maybe a bias towards smaller stocks. But it's kind of the same story in that over the last decade, those large cap, top heavy indices have really outperformed. And there's some significant valuation advantages in even some of the US pockets of the market that have underperformed today. But certainly in European markets and other international markets, we see pretty massive discounts in terms of valuations. One of the challenges is what's the catalyst that may allow those to either grow their earnings above average or maybe expand their multiples? So I know that's a really long question, but
yeah, sure.
How are you thinking about that from what's the catalyst that might allow these stocks after a period of underperformance to maybe outperform?
Yeah, good question. I mean, they are cheap, right? One of the measures we look at is the relative PE ratios between US equities and European equities, and we look at a discount or premium to US equities. And at the moment, European equities are trading at about a 33 to 35% discount at the index level to US equities. In EM, it's similar. It's around 30%. Here in the UK, it's almost 50% discount on PEs. So your PE in the UK just above around 10, and the S&P is around 20. Mm-hmm. So those are quite significant discounts, and apart from we can kind of bang the value, or these are cheap as long as you want, but what's going to change that?
Right.
And I think the way we look at it is, where do you see higher multiples? It tends to be in higher growth areas, right? So if you're looking at some of the faster growing emerging markets, they are trading at higher multiples. And not only that, if you look at intra-market countries with higher growth, typically have higher multiples, but also if we look at time series of these PE ratios or these discounts. The one measure that we look at with currencies is, so we have a valuation measure called purchasing power parity, where we're looking at the relative value of a currency versus US dollar. And when we do that on an aggregated basis for emerging market currencies, what we see is that maps very, very well with the growth differential with the US. So as the growth differential with the US changes, we see that EM currencies get cheaper. And if you do apply the same thing to that ratio of PE multiples, you see a similar dynamic. So really what we would need to see in Europe is higher growth pushing through, which is quite difficult to see right now. We've had some pretty poor data coming out of Europe. Germany has found it particularly tough. If you look at some of the underlying data, the ECB now seems to be on pause. Inflation still remains sticky, however, and it's almost a similar dynamic to the US. The unemployment rate in the euro area is the lowest it's ever been, around 6.4%. So still a relatively tight labor market. So those rates probably have to stay higher for longer. So it's difficult to see really the growth multiple coming through in Europe. Some of the opportunities then may be outside of Europe, so looking at some of the emerging markets where you do have faster or higher growth. The other way to look at it is, as well, not to drag this on, but the makeup of the European market tends to be a lot more cyclical, and maybe that explains a lot of this undervaluation. So if you look at something like the PE of Total Energies is around 8 and a bit, and that's similar to the PE of something like an Exxon. So two energy companies in the two markets, but they're trading at relatively similar PEs. And so because European equities are much more value orientated, and we know value is particularly cheap right now, that could be an explainer for where we are, and also when European equities might start performing better is when value stocks in general start performing better.
Something else that you mentioned earlier was the fact that the U.S. dollar has been so strong that it has detracted performance from sort of the local economies, the local stock markets. And so my question for you is, as you spend a lot of time thinking about hedging currencies, and that's part of what you do in the strategy that you run. What do you think about the strength of the U.S. dollar? And we've had this really long run of sustained strength. Is this something that you would expect going forward? Is this something that maybe we'll see a pause? How should we think about that?
Yeah. So again, if we draw the timeline back a bit, the U.S. dollar, both if we're looking at like the U.S. dollar index, or if we're looking at the trade-rated real dollar. So it's essentially trade-weighted basket of the dollar, and it's adjusted for relative inflation rates over time. So if we look at that measure, the dollar is approaching the peak that we've seen historically. So the first one was around 1985, and that's where we had the Plaza Accord, which I would have been still young by then, but that's when the rest of the world, in concert with the Fed, worked to have a weaker dollar. And we recently, on that measure, that real effective exchange rate, we were about 10% below that level. The other peak was around the dot-com bubble, and actually when I joined the industry, investing in emerging markets back in 2004. That's when we had Greenspan actually talking down the dollar, because the dollar was still near that peak, and we saw that come down really to around the global financial crisis, and then the dollar's just been one-way trade since then. There is this theory that's called the dollar smile, right? And it's essentially the dollar tends to outperform when US growth is exceptional, and it's been really strong, and we've seen strong and long periods of that since the global financial crisis, where US growth has led. But we also see the dollar tend to outperform in recession type scenarios, because you get the flood of capital back into the US. Right. And so in a very high risk recession scenario, the dollar does well, and when US growth is strong, does really well. So typically at the bottom of the smile, where you see the dollar typically underperform is when we have broad global growth. In areas like times like before the global financial crisis, we had strong EM growth more globally, and so that's what we would potentially need to see. Where we're sitting right now, we're at the top of the valuation, cycle of the US dollar. It's difficult to see what's going to really trigger that lower, given that the Fed's going to remain sticky. Higher for longer is our house view. But if we do start seeing the growth differential of the US and the rest of the world compress, then we might see that bottom of that smile.
So while it's tough to see the dollar at its current point, make a case for why it will weaken, it seems like if we're close to a peak, it probably would be tough to maybe argue for the dollar to go much higher than the rest of the world currencies. Do you agree with that, or is that something that we could see it continue to push higher?
Yeah, always could.
Right,
but
of course.
It'll be exceptional. It will take a lot to do that. So the US really already has quite restrictive monetary policy rates, right? It could. I think the consensus is maybe one more or so, but you're not looking at another 5% rate rise, and so it's really that dynamic seems to be like we are in the process of that changing. And if you can get paid to wait for that to happen in some of these cheaper international asset classes, that might be a way of looking at it.
Okay, so we've talked about equities. We talked earlier a little bit about fixed income, but I know that's an area that you specialize in. So as you kind of look about the world, looking at currencies, looking at fixed income markets, where are some of the pockets of the greatest opportunities that you see?
Yeah, so when you're looking globally, particularly from a US perspective, investing in developed market global government bonds doesn't seem to make much sense right now because US policy rates are relatively high.
Sure.
So both on a hedged and unhedged basis, many of these curves in the developed market global government bond space are inverted as well. And so that makes it relatively tricky in that space. Two areas which have become quite interesting are we've ended, quite decisively ended the period of ZIRP, right? So the zero interest rate policy, which was, we saw that across most of the developed world where interest rates converged around zero. And that compressed what we call carry opportunities. So your interest rate differentials between countries. What we've seen now is that spread has increased quite significantly. And so when we're looking at currencies, a large driver of currency returns is that carry differential. And so, using that carry advantage in certain currencies definitely is quite appealing right now. We have a lot more opportunity sets. The other area is, not wanting to talk my book a bit, but we are seeing quite cheap valuations in emerging market bonds, right? And you're getting paid some really attractive yields to be in this space, and you have the potential upside from if the dollar does you move sideways or depreciate. Those are two areas where we're concentrating. You also have steeper yield curves. Positive real rates, so rates adjusted for inflation rates are positive in many of these emerging markets. So we'll continue to see quite a few opportunities there.
I want to talk about China because that, of course, is such a big part of fixed income markets and equity markets. They've gone through a period where, obviously COVID was their focus on eliminating COVID and then reopening, and things maybe haven't played out with the sort of growth that many people had either hoped for or maybe even expected. And so just in general, as you think about China, what are your expectations going forward, I guess? Do you think that there are opportunities in either bonds or in equities? And what's your forecast for the Chinese economy, at least in the next year or so?
Yeah, so there was a lot more optimism with regards to China earlier in the year, right? So we're coming out of the COVID zero policy, and that seems to have ebbed quite significantly. And really, if you look over the last few years, what seems to have been really working against growth in China there's been three policy areas which you can just quite distinctly point out. One was the zero COVID policy, where you definitely saw that go on for longer than many people expected, and it had quite a negative impact on growth and the return of domestic consumption and investment. The other area was quite a strong regulation push in the IT sector and finance. We saw that. And it took, even in the gaming industry, it took quite a significant knock out of many of these private Chinese companies. And we're starting to see some efforts to normalize that and bring that back. But that was definitely an area of concern. And the last really has been more recently, although it started quite a way back, is the real estate sector. Yeah. I think with Evergrande, they first defaulted was 2001 when we had the first issues, but that's just continued. And initially, the Chinese government did try and take out some of the froth in the real estate market, and maybe that's gone a bit too far. But having said that, there has been an effort to provide stimulus. It's been quite a drip feed. So definitely from the market's perspective, it seems to be not one real big bazooka. It's been incremental changes, trying to remove some of the restrictions in the real estate market, making it easier to take out mortgages, reducing some of the limits there and the restrictions. There's also more recently announced it was a 1 trillion RMB infrastructure increase in infrastructure. We've had some cuts on the overnight rates, and which has been relatively marginal, and on the reserve rate requirement. The one thing I would say is that within all this doom and gloom, China does have quite a lot of room to stimulate the economy, right? So they've got quite significant foreign exchange reserves. They got positive, they got leeway in their monetary policy rates, right? So they have space in order to cut rates. Their central bank balance sheet is relatively small compared to some of the developed markets, so around 15% of GDP. So if they do want to stimulate, and they have the potential to do that, and that's one thing to look out for. And really the focus is going to be on that domestic demand or consumption demand within China. One notable date might be now the 11th of November. We've got Singles Day in China, which is their equivalent of Black Friday. It's their premier shopping event of the year, and so that would be closely watched, I'm sure.
Okay, so Len, what about India? You mentioned a few times some of the growth that has taken place in India. Their equity markets have performed relatively well for most of this year. Today we look at valuations, and they've certainly moved higher. So what's your outlook for India? And I guess both bonds and stocks, but I'm more focused on stocks at this point.
Yeah, so I mean, it's one of the bright lights of EM, right? An economy growing at 7 to 8%. So and a lot of potential there, but priced accordingly, and that's maybe where the challenge lies. If we've been positive on India for quite a while, and many of the elements are in place for them to capitalize. They've got a big demographic dividend, young population, and now they've overtaken China as the world's most populous country, but also relatively low urbanization rate, so around 30-35%, whereas you see most developed markets around the 80% mark. So a lot of potential there, and quite a in a few industries they do make a big impact. But as you said, the valuations in some of their, for the aggregate market, PE is around 26. That's for the broader index. It does seem like it is quite expensive, in order to pay for that growth. And even if you look at the breakout of that index, it is quite financials heavy, which typically you would expect to be a lot cheaper.
Yeah.
So it is really it's a great story, India. We like the story. We particularly like it on the fixed income side. And you've got to be a bit more selective within equities, to find those value pockets.
So. Last question on the emerging markets. We've talked a little bit specifically about India and China. As you think about other parts of the emerging markets, are there areas where you see opportunity? And one of the risks with some of these EMs has historically been that they tend to be sensitive to Fed policy and the strength of the dollar and that sort of thing. So where do you see pockets of opportunity, and how do you see Fed policy and maybe whichever way the dollar moves impacting returns for EM?
Yeah, sure. So I think one of the areas that's quite interesting in emerging markets is Latin America, and I guess that's one point in terms of when you look at emerging markets, it's sometimes easy to brush them over with these are emerging markets, but they're quite distinct between regions and between countries. I've often said that China, given how large it is, should you include it in the emerging market bucket? The world's second largest economy, and we bundle it in with emerging markets. It clearly is. Not developed, but maybe that should be considered separately on its own. But one of the areas which has been quite interesting is Latin America, and we've seen Latin American equities perform quite well. They've outperformed the S&P 500 over the last 3 years, and they've really benefited from this commodity cycle. they weren't impacted by the negativities of or any knock-on effect from the Russia-Ukraine war, but they benefited from higher commodity prices.
Yeah.
On top of that, they've been quite, many of the Latin American countries have been quite disciplined when it's come to inflation. So they never stimulated their economies to the same degree as many of the developed markets through COVID. So they never had that huge money supply shock that you saw in the US, for example, and in Europe. But as inflation started to rise, their central banks were really proactive. So Brazil already started hiking in March 2021. I often say that these emerging markets never had the luxury of calling inflation transitory, right? Which some of these developed market central banks had, and now they've hiked rates. In Brazil's case, up to 13.75%. Inflation's come down. In Brazil, it's around 5%, and now they've been able to proactively start normalizing their policy rates, right? So their real rates are still really attractive. Brazil's put in place 100 basis points of cuts already, and that's generally pro-growth. And you could say, well, doesn't that mean if they're starting to cut rates, isn't that bad for the currency, what have you? But potentially, if they're too aggressive, but their real rates are so high relative to the US right now that they've got so much leeway to do that. So we're quite positive on Latin America. You get some really attractive yields there. In the 10-year bond space in Brazil, you're getting around 12.5%. And they're benefiting from strong commodity cycle. And then obviously you have their central banks with quite restrictive policy rates with the ability to cut. Now what you kind of mentioned, well, how does that the Fed's, what we're seeing from the Fed and the US dollar impact that. And it's really, we haven't seen them perform, at least in the bond market, we haven't seen real outsized returns. And I think part of that is related to this consternation or this concern that the Fed potentially isn't done hiking rates. But what we've seen historically is that when the Fed at least pauses their rate hiking cycle and the market starts looking down, the other way, that these emerging markets, particularly those that have strong real rates, start performing really well. And so that's why our outlook is quite positive for many parts of Latin America.
Okay, that's very helpful. My final question for you is one that I ask all the guests of the ROI podcast, so I'll ask you too, Len. There's a lot of reasons why people, especially I find fixed income managers, bond managers, tend to be pessimistic for good reason. You're managing risk. That's a big part of what you do. But I'll put you on the spot now and say, as you think about the world, as you think about the economy, maybe markets, our industry, whatever, what are you most optimistic about? And this, by the way, it doesn't necessarily have to do with financial services, but I want to know what you're optimistic about.
Yeah, right. Great question. I guess, as you say, most fixed income managers aren't that optimistic, but you need to be optimistic when you're in emerging markets, right? It is a growth space. It is, there is a lot going on, and I think that is it. Is that we've gone through a long cycle of underperformance in EM equities and in EM fixed income. It's been quite a difficult period for the asset class, and we haven't seen much flows in general in the asset class. But we're starting to see the lights or the green shoots, right? Where you've seen a lot of these EM central banks be really disciplined in their monetary policy. When I first started back in the early 2000s, you still had emerging markets that weren't targeting interest rates. They were still ad hoc, maybe targeting the money supply. And so you've really had the real strong institutionalization of these in emerging markets. And we never saw a significant wave of defaults in the more advanced EMs, even through some of these tough periods. We saw it more recently in some of the frontier markets, definitely, but we never saw that in the more advanced EMs. And so that makes me optimistic for the future of the asset class. You're getting paid really attractive yields. You get some great stories out there, and the great potential for growth and to earn some great yields in these countries.
All right. Well, we will leave it there. Really appreciate you coming on and having a chat with me. It's been very enjoyable. Maybe next time I'm in London, we can do this again.
Yeah, of course.
But thank you. And actually, maybe next time you come to the U.S. to visit, we can also have a chat.
Oh, yes, absolutely. No, that's been great. I really appreciate it.
All right.
Thank you.
Well, again, thanks for joining us. And thanks to all of you that are joining us on the First Trust ROI podcast. See you next time.